Hello, and welcome to Lockhart Professional Services Introductory class to Federal Income Tax Preparation. My name is Amelia Lockhart, and I am the owner of Lockhart Professional Services. We are a full-service accounting and tax preparation firm. This webinar is part of a series that is designed to teach you about taxes and how to prepare your own tax return. We will start this webinar with a quick introduction to the IRS website. The IRS website has a lot of tools and resources available for taxpayers. Let's check out the free tax preparation help. The IRS, along with many nonprofits, have come together over the years to offer the Volunteer Income Tax Assistant Program, also known as VETA. If you make less than $54,000 a year, you may be eligible to get your taxes prepared by a volunteer at one of the VETA locations near you. Just click here to locate a site that is nearest to you. Next, I want to show you the Interactive Tax Assistant. This interactive tool is designed by the IRS to help you answer questions about your tax returns and eligibility for certain deductions and credits. In addition, the IRS has designed a mobile app to assist you. Now you can get answers to your tax questions on the go. Finally, if you need assistance preparing your tax returns, you can use any one of the free tax return preparation software packages available on this website. For the rest of the webinars, we will be using the TurboTax package, but you can use any of the software packages that you wish. Now, before we start a tax return, let's go over the basics of your tax return. We'll start with whether you need to file, what your filing status should be, and who qualifies for exemptions or as a dependent. Please note that this webinar is for educational purposes only. We recommend that you consult with a tax professional if you have any questions. All right, now let's look at the Form 1040. This is the form that most individuals use to report their income to the IRS. Today, we will focus on these two sections, filing status and exemptions. To follow along with this webinar, we recommend that you download the following free publications from the IRS. Let's start with who should file and who must file a federal tax return. For this section, please turn to page A1 of your publication 4012. This is a quick reference to help you determining who has to file. To decide whether someone must file a tax return, you need the following individuals' information. You must know their filing status, which we will cover a little bit later, their age, their gross income, and whether they can be claimed as a dependent on another's tax return. Let's go to page A1. This chart will help you determine if you made enough income to be required to file a tax return. For example, if you are not a dependent and you are single and made less than $10,300, then you do not have to file a tax return. However, let's say that you are a full-time college student and you're under the age of 24. And let's just say you made $9,000 from your part-time job. Now in this case, because you are a dependent, we're going to have to go to the next chart. Let's go to chart B on page A2. In this case, while your parents could claim you on their tax return as a dependent, you would be required to file your own individual tax return because you earned more than $7,850. Now, just so that you know, on page A2, when they say unearned income, they were referring to the income that you did not work to make, such as interest income from your savings account. Therefore, if your income is greater than the amount listed on A1 if you're not a dependent, or on A2 if you are a dependent, or you meet any of the other conditions that are listed here, then you must file a federal tax return. So the next question is, if you do not have to file a return, then why on earth would you? Well, if your employer withheld income from your paycheck, you should file a return to get that money back from the IRS. You also may be eligible for refundable credits, such as the Earned Income Credit or certain educational credits. Let's do an example. In this case, Billy, who is a 15-year-old, made $3,000 as a bag boy at Safeway last year. Billy had taxes withheld from his paychecks. Billy's parents will claim him as a dependent on their tax return. Does Billy have to file, or should he file? The answer is that since Billy is a single dependent and his income is under the $7,850, he is not required to file. However, since he has withholdings, he can get that back if he files, so therefore he should file. Please note that whether or not Billy files, his parents do not report Billy's income on their federal return, even though he is their dependent. Now let's go over filing status. Please go to Section B of your Publication 4012. Please note that there are 5 filing statuses available on your Form 1040. There's married filing jointly, married filing separately, qualified widower, head of household, and single. Your status will affect your deductions and taxable income. Please go to page B1. This is an extremely helpful tool to help you determine your filing status. Let's go through it. Assume you are married on December 31st of 2015, but your spouse has not lived with you or hasn't even been in your house in the last 6 months of the year. Let's say you have a 3-year-old daughter who has lived with you all year too, and you have supported the cost of both yourself and your daughter. Following this decision tree in that example, you would qualify as a head of household. This in turn entitles you to a greater standard deduction than married filing separately. Let's backtrack. Now let's assume that you are married, but you don't know whether you should choose filing separately or filing jointly. If you file jointly, there is a greater deduction that is available to you, as well as certain exemptions and credits. You don't get these necessarily if you file separately from your spouse. So why would you file separately? There are quite a few reasons. Some couples file separately to preserve certain credits that might not be available to them if they file jointly, such as an individual who is married to a non-resident alien. Others might file separately just because they don't want the liability that their spouse may have misstated their income on a joint return. Couples can choose to either file their returns jointly or separately. However, if one spouse decides to file separately, then the other spouse must do the same. Using the same decision tree, let's assume that your spouse died this past year, 2015. The year that your spouse died, you can file a joint return with your deceased spouse, or you can file a separate return from your spouse's estate. But if your spouse died 2 years ago and you still have a 3-year-old daughter that you are supporting, along with keeping up your house, in that case, you would probably be a qualifying widow following this decision tree. A taxpayer is considered single if on the last day of the tax year the taxpayer was either never married or legally separated and divorced. This is sort of a default status if no other status is applicable. Head of household is a unique filing status that's available in very particular cases. A taxpayer may file as head of household if they are unmarried or considered unmarried on the last day of the tax year, and they paid more than half the cost of maintaining a household for the year, and they maintain the household for either a qualifying child or a qualifying relative. Please turn to page B2. This will help you determine whether someone has a qualifying child or a qualifying relative. We will review both in more detail later. Now let's answer a practice question. Ginger is single and paid more than half the cost of keeping up her home. Her father, whom she claimed as a dependent, lived with her all year. How should Ginger file? If Ginger's father did not live with her, but she still provides more than half of his support, which status should she choose? The answer is that because Ginger paid more than half the cost of keeping up a home for a qualifying relative, and because she claims her father is a dependent, she qualifies for head of household. Even if Ginger's father does not live with her, if she provides more than half of his support, because he is her father, she can qualify for head of household. Let's move on to exemptions. Please turn to Section C in your publication 4012. Exemptions further reduce your taxable income for the year. Taxpayers, if not claimed as dependents by anyone else, can claim personal exemption for themselves, their spouse, and any dependents. There are two types of dependents. There's qualifying relatives and qualifying children. Let's look at page C1. Please note that if you can be claimed as a dependent, you cannot claim an exemption for yourself or anyone else. It doesn't matter if you are actually claimed or not. For example, a 24-year-old full-time student cannot claim a personal exemption on their tax return if they qualify as a qualifying child for their parents. Their parents do not actually have to claim the student to disqualify the student from claiming a personal exemption. Please refer to C5 through C7 for more details. Now let's go over who can claim a dependency exemption. A taxpayer can only claim a dependent if the dependent meets the qualifying child or qualifying relative tests. Additionally, the taxpayer and their spouse, if filing jointly, cannot be claimed as a dependent by another taxpayer. Furthermore, for a dependent to qualify as an exemption, they must either be a U.S. citizen or resident of Canada or Mexico for at least part of the tax year. Please refer to page C3 for the next couple of minutes while we go over qualifying relatives and qualifying children. First, let's review who is a qualifying relative. For a taxpayer to claim a person as a qualifying relative, the person must meet 4 tests: qualifying child of another taxpayer test, member of household or relationship test, gross income test, and the support test. Let's start with the first one. The dependent must not be yours or anyone else's qualifying child. So, for example, your 19-year-old child who's a student at a community college would be considered your qualifying child for the purposes of this test, and therefore cannot be considered a qualifying relative. Next, let's look at the member, household, or relationship test. For a person to be a qualifying relative, the person must either be related in some way, whether it be family or legal, to you, the taxpayer. That means that they have to be related to you by blood or law. Or the individual must live with the taxpayer for the entire year, all 365 days, as a member of the taxpayer's household. For example, let's say that you allow a friend to live with you for an entire year because they are unemployed. In this case, they would be a member of your household and may qualify as a qualifying relative. However, it should be noted that just because you can take an exemption for someone, like your unemployed friend, it does not necessarily change your filing status. Using the same example, if you're claiming your friend as a dependent, you would still be, and you were still single, then you are considered single with one dependent. The fact that your friend is your dependent does not change you to head of household. Let's move on to the next test, gross income test. The dependent's gross income must be less than $4,000 for you to claim an exemption. If the individual that you're claiming as a dependent makes more than $4,000, then they are not a qualifying relative. Finally, there's the support test. The taxpayer must have provided more than half of the dependent's total support during the tax year. So for example, if you have a friend who's living with you for the entire year, you have to supply the entire support for that individual. If that individual works and provides more than half of their own support, then they are not a qualifying relative and they are not a qualifying dependent. Please refer to page C6 for more examples and to help you determine if you have a qualifying relative. Next, we are going to look at qualifying children. There are 5 tests for a qualified child. For a taxpayer to claim a child as a dependent, the child must meet all the following 5 conditions: the relationship test, support test, residency test, age test, and qualifying child of more than one person test. To meet the relationship test, the child must be the taxpayer's son or daughter, stepchild or foster child, brother or sister, half-brother, half-sister, stepbrother, stepsister, or any descendant of the above. For example, grandchildren, nieces, and nephews. Again, this child must be related to you by either blood or law. Next, the child cannot have provided more than half of their own support during the tax year. For example, let's just say that you have a son who is 21 years old and is a full-time student. Even though he is 21 years old and therefore under the age of 24 and is a full-time student, he may not be a qualifying child if he is providing more than half of his own living expenses. Now let's look at the residency test. In order for the child to be a qualifying child, the child must have lived with the taxpayer for more than half of the year. Exceptions apply for children of divorced, separate, or unmarried parents, kidnapped children, or for children who were born or died during the year. Temporary absences due to special circumstances such as education, illness, vacation, business, or military service are okay. The most common temporary absence is education, usually college. Now let's look at the age test. In order for a child to be a qualifying child, they must be under 19 or under 24 if they are a full-time student, or they could be any age if they are permanently disabled. Please note that the individual must be younger than the taxpayer to qualify as the taxpayer's qualifying child. For example, an unemployed older sibling who is living with you would be a qualifying relative, not a qualifying child. However, if a disabled older sibling is living with you, they would probably qualify as your qualifying child. All right, now let's look at the last test, qualifying child of more than one person. Sometimes it is possible for a child to qualify as the qualifying child of more than one person. Please go to page C4. It is important to note that even though the child can qualify as the qualifying child of more than one person, they can only be claimed by one person. For example, let's just say that a child qualifies as the qualifying child of a mother and a grandmother for the purposes of tax. In that case, the grandmother can only claim the child if the mother opts not to claim the child. If the mother claims the child, then the grandmother cannot claim the child. But what about children of divorced or separate parents? There are special rules for them. Please go to page C8. A child of divorced, separated, or never married parents is usually considered a dependent of the parent who has custody of the child for the greater part of the year, also known as the custodial parent. This is true even if the non-custodial parent provided more than half of the child's support. If the child received over half their support from a third party, such as a grandparent, neither parent can claim the child as a dependent. However, a custodial parent can agree to allow the non-custodial parent to claim the exemption for the child if the custodial parent signs Form 8332. This may also be part of a divorce decree, and depending on when the divorce went into effect, the Form 8332 may be required. Form 8332 can be used for a single tax year or for multiple years. Oftentimes, parents may alternate who claims a child from year to year. This concludes our free introductory webinar. Thank you for attending. If you are interested in more classes, please visit us at our website at www.lockhartproservices.com.